Just given the conclusion of COP26 and the climate summit, I thought I'd come up with a few options and what they could potentially look at to get exposure to this thing. So I think it's fair to say what happened over the weekend, while there has been some progress to net zero and keeping essentially temperatures rising that 1.5 degree, we're still a long way away from achieving that target. And a lot really depends on whether or not a lot of those pledges turn into legislation and countries keep their promises on implementation there. So no matter where you stand on the climate debate, I think it's fair to say that there's going to be a significant amount of investment in the sector and directed to climate-related industries over the next decade at least. I think we've reached a point in the debate where it's simply a cost-benefit analysis. The current trajectory of what global temperatures are, as well as the amount of carbon being emitted, is heading in a direction that's perhaps not what everyone wants it to be. So I guess the discussion now is it's a cost-benefit analysis, whether governments, private companies, as well as individuals want to absorb the costs and the costs with dealing with the additional natural disasters. We've seen an increase in the amount of floods, fires, drought, anywhere between 7 to 20 times the amount compared to previous decades, according to an international agency which looks at the amount of global natural disasters that are taking place at the moment. In fact, Swiss Re actually commissioned a report looking at the costs under a scenario where we do see a rise in global temperatures by about 2%, what that's going to cost in overall GDP terms. And by 2050, they anticipate about 10% of GDP will be hit due to climate change, and obviously that varies across the world, but 10% of GDP. And to give you a bit of context, in today's in nominal dollar terms, in 2019 the world produced about $80 trillion US dollars worth of GDP, so that's $8 trillion a year in mitigating and sort of fighting natural disasters. So, or they decide to invest now and limit the rise in temperatures to 1.5 degrees, essentially achieving net zero by 2050. The other major tailwind that we're seeing into the sector, and particularly into climate-related industries, investors are really starting to think differently about the way they invest. They're looking at how companies also, how they're doing on the environmental, social and governance front. So ESG is front of mind to investors now, and it's incredibly important. And in response, we've seen companies put together targets for achieving net zero. In fact, PwC also commissioned a report looking at the annual reports of all the ASX companies and found that 36%, so over a third of the ASX, have some form of net zero target included in their annual report. And so it should come as no surprise. We've seen a massive explosion in the number of ESG or sustainable type funds over the past 2 to 3 years. And I think it's a trend which I talked about earlier in the year that's not going away anytime soon. In fact, Jeremy Grantham of GMO is on the record as saying a number of years ago that global warming will be the most important investment issue for the foreseeable future. And judging by the Google search terms, as you can see, it continues to rise and become, the popularity of ESG it's as popular as ever in terms of, people wanting to find out more about it. But also a recent ASX study into investors and how they invest. I think of note there is the younger cohort, which are basically saying, or 19% of them are saying, that they consider sustainability and ESG when making decisions on what they invest in. This didn't even rate a mention over 3 years ago. So it's incredibly important for investors. And there's no hiding from the fact that there's going to be an enormous amount of investment in this space. The IEA estimates that we need more than double the amount of current investment in climate-related industries. So some of the figures that they put out there, they're saying that we need by 2030 to achieve that net zero by 2050. By 2030, we'll need at least $5 trillion or nearly $5 trillion a year spent on these industries. So some of the figures that they sort of talking around at 5 times the amount of solar capacity by 2030. Half of all developed market buildings to be retrofitted. So we're talking about energy efficient glass, solar paneling, so air conditioning being retrofitted as well. 50% of new cars sold in 2030 are electric. We've seen that in parts of the world already commissioning targets even more aggressive than that, and global battery manufacturing doubling every 2 years. So on Friday we heard from Max about a lot of company-specific examples on how you can get exposure to the theme. So this morning I just wanted to take you through some of the managed funds and the ETF options that are available in the market, specifically focusing on climate change. So not ESG per se, but they may include some ESG factors in there, but just really focused on climate change. So in terms of on the managed front, there are 3 funds out there. One's been a long-standing fund, a strategy that's been running since 2008, and 2 are still fairly new, but still worth considering in my view. So first of all, it's the Impact Sustainable Leaders Fund. It's a global team based in New York, Hong Kong, and London. So it said 20% of revenue in renewable energy, energy efficiency, technology, and the circular economy. It's an institutional strategy that's been running since March 2008. So really on the forefront of climate change. So it's got a very long track record. The nature of the fund also lends itself to more mid-cap and industrials, so which should complement many of your client portfolios, given potentially a lot of portfolios are probably more skewed to the big mega caps. It's not particularly cheap relative to the ones out there, but it is true to label and has really outperformed a number of its peers. The next one is Nick Griffin's recently launched Climate Fund. Now, Nick Griffin of Munro, it will be shortly released as an ETF, so ease to access will be there as well. Nick will be also in a few weeks' time to talk about the fund in more detail as well. So as you'd expect, being a Munro fund, it is growth oriented. It's a high conviction concentrated portfolio. We're looking at about between 15 and 25 companies, really focusing on those industries around climate change. So precision agriculture, we're talking on clean energy, clean transport, energy efficiency, and of course that whole circular economy, recycling. And it also, as always with Munro, you get pretty good support from a retail advisor perspective, because really good website videos and a lot of material that you can send out to your clients in a really retail friendly format. And the third one is Jeremy Grantham's GMO Climate Trust Fund. So they're looking at more the value end of the spectrum, companies that produce the raw materials for climate change and climate related industries. So you're talking lithium, copper. They're looking at precision agriculture, semiconductors, biofuels, wind and solar. So not much of a track record per se, because they just launched in 2017, but fees are quite competitive and some reasonable performance there. And then I'll just finish up on this slide is on the ETF side. You've got the option to go quite niche or quite broad when it comes to this thematic. So on the niche end, I know it was mentioned on Friday, this is a hydrogen exposure, which ETF Securities launched only a few months ago. It's a fund that tracks companies in the hydrogen supply chain, so obviously an emerging sector. So the fund isn't trying to pick the winners and losers. It's an equal weighted fund, approximately 30 stocks in that portfolio. And given the sector is so new and there isn't really even a GICS classification, so the indexing methodology really uses this text-based AI algorithm to determine what is hydrogen related and what's not. So be mindful of that. It's not for everyone. But if you do want some exposure to a really growing area, a really important area when it comes to the whole climate change supply chain, that's probably one of them. The 2 other ones are much broader in scope. So VanEck's Global Clean Energy ETF, and what they do is track the 30 largest players involved in that renewable energy supply chain. So companies such as Plug Power, based in the US, which gives you hydrogen fuel cell exposure. Vestas, which does based in Europe, which manufactures the wind turbines, and then Enphase Solar, obviously more linked to solar power. So being a passive index, it's going to give you a strong tilt to the most liquid and largest names, so the most established players. And given most of the established players are more tilted towards that solar end of the spectrum, you're probably going to get a little bit more exposure to that part of the supply chain there. And then finally, the last one to highlight is BetaShares ERTH, Earth. It's, in my view, it's going to give you the most holistic, climate-focused ETF, very much research-focused index, looking at companies that derive at least 50% of revenues linked to core thematics that they think will be critical for net zero 2050. This is green energy, green transportation, water and waste, and sustainable products. And if you're familiar with, the direct and indirect decarbonisation type of targets, in net zero terms, it's called Scope 1, which is direct, Scope 2 and Scope 3, which are the indirect exposure to carbon. They cover all three stages there, all three scopes. So probably the most true to label there, not the least greenwashed, if you will.